Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The price of imaginary premiums. Those who live by the sword. This week's sharp fall in US markets has taught Indian investors an expensive lesson about the perils of chasing artificial premiums. Over the past few months, a peculiar situation has developed in Indian ETFs that track US markets. These ETFs were trading at premiums of up to 20% or above their net asset values or NAVs, a phenomenon that should have raised red flags for any thoughtful investor. The genesis of this premium lies in regulatory changes. Indian authorities have restricted mutual funds' ability to invest in foreign equities. This created an unusual situation where demand for US market exposure, particularly in the high-flying tech sector, far outstripped the supply of ETF units. Since fund houses couldn't create new units, prices were pushed well above the actual value of the underlying assets. This divergence between price and value might have seemed like an opportunity to some, but it was a trap waiting to spring. These ETFs saw disproportionate losses when US markets tumbled this week, driven by concerns about interest rates and economic growth. The premium investors had paid evaporated quickly, adding to the substantial losses from the underlying market decline. The irony is that the true value of these investments was visible to anyone who cared to look. Unlike in many market situations where value is debatable and requires careful analysis, it was displayed in black and white through the daily NAV calculations. Yet, investors chose to pay significantly more than this known value, presumably betting that someone else would pay even more, the very definition of greater fool theory. This situation is particularly noteworthy because it involves sophisticated investors who should know better. These aren't small retail investors being misled by complex financial products. They are often well-informed market participants who convinced themselves that the circumstances somehow justified paying more than the fair value. The episode reminds us of the fundamental principle that price and value are distinct concepts that temporarily diverge but inevitably converge. When that convergence happens, it's usually swift and painful for those on the wrong side of the trade. In this case, investors weren't just facing the normal market risks of their substantial US tech investments. They were also carrying the additional risk of an unsustainable premium. For policymakers, this situation offers some food for thought. While restrictions on foreign investments may be necessary for managing capital flows and maintaining financial stability, they can create distortions that ultimately harm investors. When regulatory constraints create artificial scarcity, markets often respond with equally artificial premiums that mask real risks. The lesson for investors is clear. There's no substitute for fundamental value. You can make reasonable bets on how a company might perform, how an economy might grow, or how technologies might evolve. These are fundamental judgments about value creation. But betting on temporary price anomalies caused by technical factors is speculation, not investment. Moreover, such situations often end badly because they're self-limiting. Either the regulatory constraints will eventually ease, eliminating the premium, or market forces will find other ways to provide similar exposure, achieving the same result. The only question is how much money investors will lose before this happens. As the dust settles on this week's market action, it's worth remembering that true investing is about participating in businesses' real growth and value creation, not trying to arbitrage temporary market distortions. Whether you're looking at US tech stocks, Indian blue chips, or anything in between, the principle remains the same. Focus on underlying value, not market mechanics. For those who paid the premium and regret their losses, the silver lining is that expensive lessons tend to be the ones we remember best. You will not forget this in a hurry. Often, the most valuable investment insight comes not from what we gain, but from what we lose, and, more importantly, how we lose it.